Well, with the ongoing U.S. banking crisis, investors are searching for answers and new opportunities amid the volatility. Joining us now is Andrew Slimmon, Morgan Stanley Investment Management Managing Director and Senior Portfolio Manager. It's good to talk to you today. Let me just get your take, first of all, on what we heard from Austin Goolsbee saying that he's starting to see some of that credit squeeze happening or credit tightening. What does that mean from a market perspective as you're watching it?
Well, it is pretty amazing all we've gone through year to date, and yet the S&P is up 7-8% for the year. I think it shows incredible resilience. Is the market sitting around waiting for resolution about the economy? I'm not so sure. I think it's that the stock market's had 2 years of going nowhere, and there's probably a high level of selling exhaustion, which is really keeping the market from trading down on bad news. Doesn't necessarily mean the market will go higher, but it just definitely keeps keeps a floor in the market.
Andrew, do you think that there is a slight risk here that the market, though, is being too complacent, given the fact that we've seen stress in the banking system? Signs here, some are saying that we're in the midst or starting to see a credit crunch. And then we also have the standoff going on down in D.C. over the debt ceiling.
I think that's absolutely right. I'm worried. Short term, I'm worried because Congress usually doesn't act until financial markets really force them to act. And I think Congress is looking at the market going, well, nothing to worry about. So as we get closer to the date, I suspect you'll see some more volatility, which is code word for the market going down, which will force action. So, yeah, I am short-term nervous that the market is taking this all in stride and doesn't believe that there will be a funding issue and they'll come to resolution. And I bet they will. It's just only when they start to worry about the volatility they're causing.
Yeah, I mean, how significant a risk are we talking about right now? I mean, the choppiness we have seen, sure, this week we're focused on politics. Last week it was the banks. But as a market event, how significant is this as we get closer to the June 1st?
Well, the market never reacts the same way twice, and it overreacted to the funding crisis in 2011. We had a big drawdown, and then they came to a resolution, and the market came roaring back. So I don't think we'll see that level. The second thing is I go back to the market's gone nowhere for 2 years, so I have a hard time seeing people say, "Okay, now's the time. I'm going to give up. I've stuck through 2 years of going nowhere. I'm giving up on the market." I have a hard time seeing it. I just don't see it in flows where there's actually people pulling. I just think we're caught in this range. Could we trade down to the lower end of the range, 3,800? I think that's a possibility, but I don't think we're going to retest the October lows. And I have a hard time until later this year seeing the market break to the upside, which I think will happen, but it's premature, and we've got this debt issue in front of us.
Yeah, massive debt issue just a few weeks ahead here. Andrew, so then what should investors then be doing at a time like this? There's so much uncertainty. It doesn't sound like you think we're going to see a heck of a lot of movement, at least in the short term. Should investors be staying on the sideline or at least leaving their portfolio untouched?
Well, there's invested and then there's not invested. And the number one thing I worry is that I hear a lot of people say to me, well, I'm going to commit when we get this drawdown that so many people on Wall Street are predicting. That hasn't happened this year. They've been predicting it since the beginning of the year. I don't think we're going back to retest the low. So my worry is a lot of cash waiting for a retest. I don't think it's coming. If you're invested, I think it's going to be I don't think we're going to be much further ahead than we are now. Come, September, I think it's going to be a good third and fourth quarter because the market's going to start to price in a reacceleration in earnings next year. It's just premature now. So if I'm wrong and we have a bigger drawdown this summer, I doubt it. But if it happened, then I would look to put money to work. But I certainly wouldn't pull out the errors Look at what's happened so far this year. You know what's a great little analogy? Last year, energy was the best performing sector. And as we came into this year, a lot of people liked energy stocks. It's the worst performing sector this year. Stock market did poorly last year, came into this year, a lot of people negative. It's done well. So the message is trying to time the market is a fool's game. And I would be careful on getting out, thinking you get back in, given the fact that the stock market has gone nowhere for 2 years, and usually in that type of period, it's only time until it breaks to the upside.
Yeah, don't try to time the market. That's consistent messaging that we've heard over the years. Andrew, you talked about opportunities in the U.S. What about outside of the U.S.? We've had a number of guests who said they are starting to see some opportunities pop up, especially in emerging markets. What are you watching?
Sure. So first of all, China, the Chinese market rallied 100% off the low from October until end of January. And now it's retraced a portion of that. And I think a lot of people are throwing in the towel. And I think it rallied too quickly it takes time for an economy to reopen after COVID. So I think that market still, you have a government that's trying to stimulate their economy. You have a bank, central bank that's stimulating the economy. I think that's intriguing, but you have geopolitical risks there. So you have to be careful on how much you invest in a part of the world. I think Europe is attractive because the dollar, after going, vertical for a very long time, which really killed non-U.S. investments, I think Europe is attractive also because it is a play on an opening in China, and valuations are very cheap because people expected a nasty winter, and it turned out not to be the case. So I'm more optimistic near term on emerging markets in Europe than I am on at least the S&P cap weighted.
Some good takeaways there. Andrew Slimmon from Morgan Stanley. Great to talk to you today. Appreciate the time.